Welcome, curious minds, to another deep dive. Have you ever found yourself looking at a massive new corporate headquarters, maybe a sprawling manufacturing plant, or even just, a company's fleet of shiny delivery vehicles, and wondered what really goes into that enormous number listed as an asset on their financial reports? We often see a single price tag, but the truth is, well, the journey to arrive at that reported value is far more layered, intricate, and honestly surprisingly fascinating than just the initial purchase price.
It's a fantastic question, and one that often gets overlooked. What appears as a simple, straightforward figure on a balance sheet is actually the culmination of a series of very precise accounting decisions, each one with its own set of detailed rules and, frankly, significant implications. It's a bit like admiring a finished complex machine without ever seeing the blueprint or the part sourcing or, the assembly line that brought it all to life.
That's a perfect analogy, and that's exactly what we're here to do today. We're going to pull back the curtain and unravel that intricate world of property, plant, and equipment, or as the accounting pros call it, PP&E. Specifically, we're diving deep into how companies determine the cost basis for these foundational assets. And like you said, this isn't just about what they originally paid for it. It's about every single cost incurred to get that asset from concept to fully operational, ready-for-use condition, whether we're talking about a multi-million-dollar factory or a highly specialized piece of machinery.
Absolutely. Our mission for you today is to take your source material, this comprehensive look into these complex accounting principles, and really distill it into truly impactful insights. We want to simplify what can feel incredibly dense, give you those genuine aha moments that, transform a seemingly dry topic into crystal clear understanding, and show you precisely what costs are included in these foundational assets, and importantly, why knowing this is so critical for truly grasping a company's financial health.
Absolutely. By the end of this deep dive, you'll not only have a firm grasp of what costs are included in these critical assets, but you'll also understand why these distinctions matter so much, especially when you're trying to understand a company's true financial picture. We promise clear explanations, some genuinely surprising facts, and enough detail to make you feel genuinely well-informed, all without feeling, overwhelmed. So let's begin our exploration and unpack this truly foundational area of business finance. Okay, so to really get a handle on PP&E cost basis, we first need to lay the groundwork. What exactly are these things we call fixed assets, and why does their valuation hold such immense significance for a company?
That's the logical starting point, definitely. At their core, property, plant, and equipment, often just called fixed assets, are unique. The crucial distinction, and this is really key, is that they are acquired specifically for use in operations and absolutely critically not for resale. That's what sets them apart from something like inventory. Think about it. A car manufacturer buys steel and tires to build cars to sell that's inventory. But that same car manufacturer buys huge stamping presses and robots to make the car. Those are PP&E.
Got it. So if I'm understanding correctly, they're the enduring tools, the physical infrastructure, the land, basically the stuff that allows a business to actually do what it does day in and day out. They're not short-term investments you're looking to flip, nor are they products you're selling directly. And they come with a few defining characteristics, don't they?
They absolutely do. First, they possess physical substance. This just means they're tangible, you can see them, touch them, they occupy a space. We're talking about concrete things like factory buildings, machinery, or the land itself. Second, they are long-term in nature. This is key. They're expected to provide economic benefit and contribute to revenue generation for more than just one accounting period, often, many years. And third, they are subject to depreciation.
Depreciation. That's a term many people hear, but maybe don't fully grasp in this specific context. Could you give us a quick, clear explanation of what that implies for these particular assets?
Certainly. Depreciation, in accounting terms, is basically the systematic process of allocating the cost of a tangible asset over its estimated useful life. So instead of recording the entire multi-million-dollar cost of, say, a new factory as an expense in the single year it was purchased, which would, drastically distort that year's profitability, the cost is spread out. It's spread out as an expense over the many years that factory is expected to generate revenue. It's really an essential principle of matching expenses to revenues, making sure that the cost of using the asset is recognized in the periods where it actually helps generate income. It just paints a much more accurate picture of a company's financial performance over time.
That makes a lot of sense, provides a truer reflection of profitability. So given their significance and their long-term nature, how do these assets typically appear on a company's financial statements? Like on the balance sheet?
Right. On the balance sheet, these assets must be presented separately, or at the very least, detailed comprehensively in the footnotes to the financial statements. And a foundational principle here is that they are always initially recorded and presented at their original cost, or historical cost.
Yeah.
That's a bedrock accounting principle.
And within PP&E itself, are there distinct categories that companies typically break out for clarity?
Yes. The three main distinct categories are land, property, buildings, plant, and equipment. Now, within the equipment category, if a company has significant investments in various subtypes, they might choose to show things like machinery, tools, furniture, and fixtures separately, just to offer more granular detail to anyone analyzing their financial position. You know.
And then we have this accumulated depreciation account. That sounds a bit like a paradox, an account that actually reduces the value of an asset. How does that work?
It's precisely what it sounds like, yeah. And it's often referred to as a contra asset account. It's basically a separate account that meticulously tracks the total amount of depreciation expense that has been recognized on an asset since it was acquired. So it works against the original cost of the asset. If you take the original historical cost of the asset and subtract its accumulated depreciation, you arrive at the asset's net book value on the balance sheet. And for reporting simplicity, sometimes this accumulated depreciation account might be combined for two or more asset categories.
Okay, so if a company bought a building for, say, $20 million, and over several years, $5 million in depreciation has been accumulated in this contra asset account, its net book value on the balance sheet would show as $15 million, even though its original cost still stands at $20 million on the books somewhere. It's like a transparent ledger of how much of that asset's value has been gradually used up or allocated over time.
That's a perfect way to visualize it. It offers transparency, it reveals both the initial investment and how that cost has been systematically allocated over the asset's useful life. It's really a key piece of information for financial analysts.
Okay, that foundational understanding of PP&E is incredibly helpful. Now, let's dig into the nitty-gritty. How are these assets actually valued? Because it's clearly much more than just a simple sticker price, isn't it?
Absolutely, not just the sticker price. The historical cost principle is the absolute cornerstone here, at least for purchased fixed assets. It dictates that an asset should be recorded at the exact price paid to acquire it. But, and this is the important part, the price isn't just the amount on the sales invoice. It's measured by the cash or cash equivalent price of obtaining the asset and bringing it to the location and condition necessary for its intended use.
Right, so it's all about getting it fully ready to perform its intended function. Can you give us maybe a real-world scenario or an analogy to truly bring that concept to life?
Sure. Let's imagine a tech company building a new state-of-the-art data center. When they purchase the specialized cooling systems for the servers, the historical cost isn't just the, say, $2 million they pay the manufacturer. It would also include the freight charges to ship those massive, delicate units from maybe Asia to their site in North America. And perhaps they needed specialized heavy-duty cranes and engineers to install them, to ensure they're perfectly calibrated and integrated into the building's infrastructure. The cost of that specialized installation, including all the initial testing to verify it's performing optimal, all of that would be part of the cooling system's capitalized historical cost. It's every dollar spent to make it operational.
That example makes it incredibly clear. It really highlights how many sort of hidden costs contribute to that final asset value beyond just the purchase agreement. But what happens in a less common but still very important scenario when assets are donated to a company? For instance, maybe a city government donates a piece of land to a company to incentivize building a factory there. How does that work?
That's a truly fascinating situation. And it's handled quite differently precisely because there's no actual purchase price involved. Donated fixed assets are recorded at their fair market value at the time of the donation. This is basically the estimated price it would fetch in an open market transaction. And, of course, any incidental costs incurred by the company to receive or get the asset ready for use would also be added on top of that fair market value.
So if that piece of land is independently appraised at, say, $5 million, that's the value the company would put on their books.
Exactly right. And here's where it gets really interesting and provides one of those crucial aha moments we talked about. Donated fixed assets actually result in the recognition of a gain on the income statement. The accounting entry you typically see would be a debit to the fixed asset, FMV, account for the appraised value, and a credit to a gain on non-reciprocal transfer account for the same amount.
Wait, hold on. Again, that seems completely counterintuitive. My first thought is, how can you recognize a gain when you didn't sell anything or even receive cash? Can you break down the economic logic behind that?
It's a great question, and it really challenges our everyday understanding of what a gain is. From an accounting perspective, a gain is essentially an increase in economic resources that isn't from the company's primary operations or direct investment activities. Here, the company has received something of significant value, a substantial asset, without having to spend any cash or give up any other assets in exchange. It's a pure, uncompensated inflow of economic benefit, right? So to accurately reflect this increase in the company's wealth, accounting principles dictate that it must be recognized as a gain on the income statement. It's a non-cash gain, sure, but it absolutely boosts their reported profit for that period, reflecting a genuine increase in the company's net worth.
Wow. That truly reframes how I think about donations on a company's books. It's not just a free asset showing up, it's actually a direct boost to their reported profitability for that period. That's a powerful insight. Okay, we've covered the fundamental definition of PP&E and how general valuation principles apply, including that really intriguing point about donated assets generating gains. Now let's take a surgical deep dive into the specific categories, starting with property, which in the accounting world primarily means land. And believe me, as you hinted, the true cost of land goes way beyond just the purchase price.
It's astonishing, really, how many different costs get bundled into that single line item for land. When land is acquired specifically for the purpose of constructing a building, it's absolutely crucial to understand that all costs incurred up to the point of excavation for the new building are considered land costs. This is often counterintuitive because it includes a lot of activities that might feel like construction, but they're really about preparing the ground itself.
Right, preparing that plot of earth for its ultimate purpose, holding a new structure. So what specific expenditures get lumped into that land cost? I'm guessing it's more than just the amount you wire to the previous owner.
Oh, much more. Of course, the purchase price is the obvious starting point, but then you layer on what we call acquisition fees. These are essential to legally and officially secure the property. We're talking about things like broker's commissions for the real estate agents,
Right.
title and recording fees to legally transfer ownership and register the deed, and legal fees for the attorneys who make sure all the contracts are sound and there are no hidden issues or disputes. Without these, you don't truly legally own the land.
Okay, so getting the legal right to that parcel means more than just paying the seller. What about the physical preparation of the land itself, like
Yeah.
getting it ready?
Exactly. That's where site preparation comes in, and it can be quite substantial. Imagine acquiring a piece of land that's just raw, undeveloped wilderness. The cost of draining of swamps, maybe clearing of brush and trees, and extensive site development. For instance, grading of mountaintops to make a pad, a level surface suitable for construction, all become part of the land's cost basis. These are often significant efforts just to make the land fundamentally usable and stable.
That sounds like a lot of work and expense before you even think about laying a single brick for the actual building. What about any existing financial burdens tied to the land, like old debts?
Excellent point. Existing obligations assumed by the buyer are also added to the land's cost. This means if you purchase a piece of land and agree to take on, say, an outstanding mortgage that the previous owner had, or you have to clear up any back taxes that were owed, those financial responsibilities you assume become part of your overall investment in that land.
And here's the one that genuinely caught my eye in the source material because it seems so surprising. Costs of raising, tearing down an old building, demolition. If a company buys land that already has an old building on it, but their intent is to build a new structure, the cost to tear down that old building is part of the land cost. That seems incredibly counterintuitive. Why isn't it part of the new building's cost?
It is counterintuitive at first glance, I agree. But the accounting logic is actually very sound. If the sole purpose of acquiring that land was always, from the outset, to tear down the existing old structure and erect a new one, then the demolition cost is considered a necessary expenditure to get the land itself into the condition required for its intended use, which is to be a clear site for a new construction. You couldn't build your new structure without first removing the old one, right? Therefore, it's a cost of acquiring and preparing the land, not a cost directly related to constructing the new building. It truly hinges on the intent at the time of purchase.
That's a critical distinction based on intent. Wow. It really emphasizes how accounting looks at the why behind the expense, not just the what.
Hmm.
And I assume there are also things that can reduce the land's cost, offsets.
Yes, definitely. There can be offsets. If you demolish an old building, or maybe clear timber from the land, and you're able to sell some of the salvageable materials like old bricks, scrap metal, or valuable logs, those proceeds from sale of existing buildings, standing timber, etc., actually reduce the capitalized cost basis of the land. They partially offset your initial investment.
Okay, so the ultimate goal is to arrive at the true net cost of that bare, ready-to-build-on piece of land. Now, you mentioned that land itself is generally not depreciated, but then we have this category called land improvements. What's the crucial distinction there, and what falls into that category?
This is a very important differentiation, yes, and it's often a point of confusion. While land itself is generally considered to have an indefinite useful life and is thus not depreciated, land improvements are depreciable. These are additions or enhancements to the land that improve its utility or appearance but have a finite useful life. They will eventually wear out, deteriorate, or become obsolete.
So what specific things are we talking about here? Give us some concrete examples of what counts as a depreciable land improvement.
Think about things like installing fences around the property boundary, setting up water systems for irrigation or specific industrial uses, building sidewalks for pedestrian access. Also, laying down paving for parking lots or driveways, undertaking decorative landscaping that requires ongoing maintenance and eventual replacement, and installing lighting for security, aesthetics, or operational purposes. All of these enhance the land, but clearly have a measurable, limited lifespan.
Ah, okay. So the land itself might be forever, but the paved parking lot on top of it definitely isn't. That makes perfect sense. And you also hinted earlier that interest costs during the construction period should be added to the cost of land improvements based on the weighted average of accumulated expenditures. We'll dive much deeper into construction period interest later, I know, but it sounds like even for these smaller, specific improvements, financing costs can be part of their capitalized value.
That's correct. If those improvements are substantial and constructed over a period of time, and they require financing, those interest costs can indeed be capitalized, just as they might be for larger buildings or major equipment. It's a subtle but important detail that just underscores the thoroughness required in these cost basis calculations.
And speaking of those subtle but crucial points, the source provides a fantastic passkey insight for really distinguishing between land and building costs during the preparatory phase. It's a key distinction for anyone delving into this. Can you walk us through that nuance?
This is indeed where the fine line is drawn, and it's a detail that really helps solidify understanding. The pass key from your source material clearly differentiates these two. It says land cost, filling in a hole or leveling. This describes activities focused on making the land itself, its topography, suitable for any general construction, basically preparing the site. However, the rule shifts when it states building cost, digging a hole for the foundation. This indicates the precise moment an expenditure transitions from preparing the land for a structure to actually beginning the construction of a specific building.
So, general site leveling work like filling in low spots or making it flat, that goes to the land cost. But the specific excavation for this particular building's foundation, that cost goes to the building itself.
Exactly. And the why it matters here is absolutely fundamental for accurate financial reporting. Remember, land is generally not depreciated because it has an indefinite useful life, while buildings are depreciated over their useful lives. If you misclassify the cost of digging a foundation hole as a land cost instead of a building cost, you'd incorrectly treat a depreciable asset cost as non-depreciable. This would then lead to understated depreciation expenses on the income statement over the life of the building, and consequently, an overstated net income in future periods. It just highlights the absolute precision required in this area.
That's a massive insight. It truly is all about where that line is drawn and how that decision impacts the financial statements for potentially years to come. So we've meticulously unpacked property and its surprising layers of cost, particularly the distinctions between land and land improvements. Now, let's turn our attention to plant, which primarily refers to buildings, and then to equipment, which, encompasses pretty much everything else that keeps operations humming. The costs here are also far more comprehensive than you might initially imagine, right?
Indeed. When it comes to the plant or buildings, the cost goes well beyond the basic purchase. Of course, if a company is acquiring an existing building, the initial purchase price is the core capitalized amount. That's the starting point. But there are numerous other expenditures that must be added to that base to get the building ready for its intended use.
What else specifically gets capitalized as part of a building's cost? What kind of things?
Well, a significant one is something called deferred maintenance. This refers to all repair charges neglected by the previous owner. Imagine acquiring an older building that, while maybe structurally sound, desperately needs a new roof, or complete rewiring, or a plumbing overhaul just to be made functional and safe. These aren't routine maintenance for your ongoing operations. They're necessary expenditures to get the building into a usable condition before you can even begin to use it for its intended purpose. So those costs are rightfully capitalized as part of the building's total cost.
Ah, okay, so it's not just buying a fixer-upper, it's buying a fixer-upper where the cost of the fixing directly increases the asset's value on the books because it was needed before you could use it. That's a crucial distinction. What about enhancements or changes the new owner makes themselves, like upgrades?
Yes, absolutely. Alterations and improvements made to the building that significantly enhance its value, extend its useful life, or increase its capacity are also capitalized. For instance, adding a new wing to an existing factory, or maybe upgrading the internal structural elements for greater load-bearing capacity. These are direct additions to the building's long-term value. And naturally, things like architects' fees for design, planning, and overseeing construction are fundamental costs, whether you're constructing a new building or significantly modifying an existing one.
And that familiar phrase pops up again. Possible addition of construction period interest. We're definitely going to tackle that complex beast of a topic shortly, but it's becoming increasingly clear that it applies across the board for major self-constructed assets, whether it's land improvements, buildings, or even equipment.
It truly does. It's a pervasive and often substantial cost that needs careful consideration whenever an asset is built over time and requires financing.
Now, what if a company makes what's called a basket purchase, like when they buy land and an existing building together for one lump sum rather than as separate transactions? How do they possibly allocate that single purchase price between two distinct assets when one is depreciable, the building, and the other, land, generally isn't?
This is a very common scenario, especially in real estate transactions. When land and an existing building are acquired together for a single, undifferentiated lump sum price, the standard accounting rule is to allocate the purchase price based on the ratio of appraised values of individual items.
Okay, can you walk us through a quick example just to clarify that allocation method?
Certainly. Let's say a company pays a combined $5 million for a property that includes both land and an existing office building. To properly allocate this, they would typically get an independent appraisal. Let's say that appraisal values the land at $1 million and the existing building at $4 million. So the total appraised value is $5 million. The land represents 20% of that total appraised value, with all of $5 ours, and the building represents 80%. $4 to $5. The company would then allocate 20% of its actual $5 million purchase price, which is $1 million to land, and 80%, or $4 million to the building.
And why is this allocation so fundamentally crucial? Why not just lump the entire $5 million under property, plant, and equipment as one big combined asset?
It goes right back to our earlier discussion about depreciation, which is probably the single most critical reason. Land, as we've noted several times, is generally not depreciated because it's considered to have an indefinite useful life. The building, however, is depreciated over its estimated useful life. If you simply put the entire $5 million under a single undifferentiated asset category, you wouldn't be able to properly calculate and record depreciation expense for the building portion. An incorrect allocation would lead to distorted depreciation expenses on the income statement, ultimately resulting in an inaccurate representation of the company's profitability and asset values over time. It's absolutely essential for accurate financial reporting.
That makes perfect sense. Every dollar needs to be categorized correctly to paint the true financial picture. So, moving on to the last big category, equipment. What all falls under this incredibly broad category, and what specific costs go into its capitalized value?
Equipment is indeed a very expansive category. It basically encompasses a vast array of tangible assets used in operations that aren't easily classified as land or buildings. This includes everything from relatively small items like office equipment, think computers, printers, projectors, and furniture for offices and common areas, to larger-scale items like specialized machinery on a factory floor, various tools, fixtures like built-in shelving or specialized lighting systems, and general factory equipment. Essentially, any tangible asset that's vital to the company's daily functioning but isn't land or a building structure.
And the cost inclusions for equipment. I'm guessing they'd follow a consistent philosophy to what we've discussed for buildings and land. It's all about getting it ready for use, right? What are the specific elements that get included?
You're absolutely right. The philosophy is consistent. All expenditures directly related to the acquisition or construction, and then the subsequent preparation of the equipment for its intended use, are capitalized. This obviously begins with the invoice price, the initial cost you pay the seller. From that starting point, you then subtract any cash discounts and other discounts you might have received, as these directly reduce your actual cash outlay and thus the true cost of the asset.
So any discount you negotiate or receive directly reduces the asset's capitalized value. That makes sense. Less cash paid, lower asset cost.
Precisely. Then you add freight in, which is simply the cost of shipping the equipment from the vendor's location to your facility. This also includes any insurance while in transit and while in construction to protect your investment during that vulnerable delivery and setup phase. Crucially, you also add installation charges. And this goes beyond just physically placing the equipment. It specifically includes testing and preparation for use. Ensuring the equipment is fully operational, properly calibrated, and integrated into your workflow before it can actually start producing value.
Right. So it's not just plugging it in, but literally making sure it works properly and is producing exactly what it's supposed to before you even consider it fully ready.
Exactly. You also need to include sales and federal excise taxes that are directly attributable to the purchase of that specific piece of equipment. And once again, for equipment that is self-constructed by the company, there's that possible addition of construction period interest, a topic we are definitely going to unravel thoroughly in just a moment.
It's truly incredible how much detail and how many different cost elements contribute to that single number you might see on the balance sheet for something like equipment. It's so far from just the advertised sticker price. This leads us perfectly to a fundamental and incredibly important question in accounting for all PP&E, to capitalize or to expense. This isn't just some minor accounting nuance, is it? It's a decision with a direct, profound, and immediate impact on a company's reported profitability in any given period.
You've hit on an absolutely critical point there. The core idea, the guiding principle, is that proper accounting is determined based on the purpose of the expenditure. This distinction is absolutely critical because it dictates whether an outflow of cash immediately reduces current period profit that's expensing, or if it adds to a long-term asset that will be systematically depreciated over many years that's capitalizing.
Why does this distinction matter so much for someone like me or our listeners trying to understand a company's financial statements? This really sounds like a potential aha moment for interpreting financial reports beyond just the surface numbers.
It truly is transformative for understanding. When a company expenses an item, that cost immediately hits the income statement as an expense in the current period, directly reducing current profit. This means the reported net income for that period will look lower, all else being equal. However, when an item is capitalized, it's instead added to an asset account on the balance sheet. Its cost is then spread out over the asset's useful life through depreciation, impacting the income statement much more gradually over many years. This single decision can dramatically alter a company's reported profitability and its asset base in any given year, even if the underlying cash outflow for the expenditure was exactly the same. Understanding this helps you look beyond the raw numbers.
Okay, so let's break down these crucial decisions then, starting with what are called additions.
Right. Additions increase the quantity of fixed assets. These are essentially brand new assets or significant expansions that create entirely new future economic benefits for the company. Because they fundamentally add to the company's productive capacity or asset base, they're always capitalized. This means the company adds that cost directly to the asset's value on their balance sheet, reflecting that their overall asset base has physically grown.
Okay, that seems straightforward enough. If you buy a completely new piece of machinery, it goes onto the books as an asset. Makes sense. What about improvements and replacements? This sounds like it could get a little trickier given you're dealing with existing assets, not just adding new ones.
It certainly does get more nuanced here. Let's start with improvements, which are also commonly known as betterments. These actions improve the quality of fixed assets. An excellent example provided in your source is when a tile or steel roof is substituted for an old asphalt roof. This isn't just patching a leak. It's a significant upgrade that enhances the asset's overall quality, potentially extends its life significantly, or improves its functionality well beyond what a simple repair would achieve. Because they genuinely enhance the asset's future economic benefits, they are capitalized to the fixed asset account. They essentially increase the asset's recorded value on the books.
Okay, so making an existing asset genuinely better gets capitalized. What about replacements? That sounds more like simply swapping out an old part for a new, similar one, maybe not necessarily making it better in quality.
You're right, that's precisely the distinction. In a replacement, A new simile asset is substituted for the old asset. For example, like you said, an asphalt shingle roof is replaced with a roof of similar material. Maybe the old one just wore out. This is where the accounting gets particularly nuanced, because the correct treatment largely depends on whether the carrying value of the old asset is known.
Carrying value, that's the original cost minus accumulated depreciation, right? So
Yeah.
whether you know the book value of the specific part being replaced.
Exactly. So walk us through those different scenarios, depending on whether you know that carrying value or not.
Okay.
Scenario 1. If the carrying value of the old asset is known, meaning you know exactly what that old component, like the old roof section, was worth on the books at the time you replaced it, then the process is relatively clean. You first remove the old asset's carrying value and recognize any gain or loss on its disposal, almost as if you sold that component for zero. After that, you simply capitalize the cost of the improvement or replacement to the asset account. You add the cost of the new component. This is the cleanest scenario, as you're effectively swapping out one specifically identified asset component for a new one directly on the books.
Okay, so if you replaced a specific component that had, say, $10,000 of remaining book value on the books, you'd take that $10,000 off the books, probably recognize a $10,000 loss, and then add the, say, $15,000 cost of the new component to the asset's total value.
It's exactly right. Now, it gets more common and slightly more complex if the carrying value of the old asset is unknown. This happens frequently, especially with older assets or components that weren't tracked separately. In this very frequent situation, you have two potential sub-scenarios based on the impact of the expenditure. First, if the asset's life is extended. For instance, a major engine overhaul that significantly prolongs the useful life of a company vehicle, but you don't know the exact book value of the old engine parts you removed. In this specific case, you debit accumulated depreciation for the cost of the improvement replacement.
Whoa, wait. Debit accumulated depreciation? That sounds really counterintuitive to many listeners, myself included sometimes. Usually, debits increase an account balance. How does debiting a contra asset account like accumulated depreciation work here, and why do it this way?
That's an excellent question, and it's where the aha really clicks for some people, understanding this nuance. Debiting accumulated depreciation actually reduces the accumulated depreciation balance. Remember, accumulated depreciation is a negative number on the asset side, representing the portion of the asset's cost that has already been expensed over time. By reducing that accumulated depreciation balance, making it less negative, you are effectively reversing some of that past depreciation, which in turn increases the asset's net book value on the balance sheet. This treatment effectively reflects the fact that the asset's remaining depreciable life has been extended. You're spreading its remaining costs over a longer period because the overhaul has indeed given the asset a new lease on life. It's a clever accounting mechanism to capitalize the expenditure and reflect its long-term benefit when you can't precisely identify and remove the old replaced component from the books.
Fascinating. So instead of adding to the asset's cost directly, you're effectively saying, hang on, this asset isn't as used up as we initially thought, thanks to this significant investment we just made. That's a really clever accounting solution.
It truly is. Now, the second sub-scenario, still assuming the carrying value of the old asset is unknown, is if the usefulness, utility of the asset is increased. This means the asset can now do more, perhaps perform at a higher capacity, operate more efficiently, or produce better quality output than before, even if its life isn't necessarily extended. In this case, you simply capitalize the cost of the improvement replacement to the asset account itself, just like you would for a brand new addition or a betterment.
Okay, so increased life hits accumulated depreciation, if old value unknown, but increased utility or capacity goes directly to the asset account. It's all about the impact and the purpose of the expenditure. That's the recurring theme. Now let's talk about repairs. This is something virtually every company deals with constantly. What's the accounting distinction here between different types of repairs? It can't all be capitalized, surely.
No, definitely not. Here, we clearly differentiate between ordinary repairs and extraordinary repairs. Ordinary repairs are your routine day-to-day maintenance activities. Think of changing the oil in a company vehicle, replacing a single worn-out tire, patching a small hole in an office wall, or just regular cleaning and upkeep. These expenditures simply keep the asset in its normal operating condition, but do not meaningfully extend its useful life or significantly increase its usefulness beyond its original design capabilities. Therefore, they should be expensed as repair and maintenance. They are treated as period costs, impacting the current period's profit directly.
Okay, so ordinary, keep it running repairs hit the income statement immediately as an expense. Makes sense. What about extraordinary repairs? These sound much more significant, like major work.
They are indeed. Extraordinary repairs are much more significant in scope and impact. These are major overhauls or replacements of substantial components, like completely replacing an entire engine block in a large delivery truck, or maybe a major rewiring of a significant section of a factory building. These types of repairs do materially extend the asset's useful life or significantly increase its utility or capacity. Because they provide future economic benefits similar to new assets or significant improvements, they should be capitalized. And the rule is you treat the repair as an addition, improvement, or replacement as appropriate, meaning the specific rules we just discussed for additions, improvements, and replacements apply based on their precise impact, increasing quantity, life, or usefulness.
Got it. So it's not just about the size or cost of the repair in dollars, but fundamentally its impact on the asset's future productive life or its capacity to generate revenue. That's the real guiding principle.
Exactly. It really boils down to whether the expense just maintains the status quo or if it fundamentally enhances the asset's future economic potential.
The source also provides a fantastic summary chart that kind of ties all these crucial accounting decisions together into a really concise framework. Can we quickly walk through that just to solidify our understanding? It feels like a great cheat sheet for these rules.
Absolutely. It's an excellent distillation, makes it much easier to remember the key pathways. So for additions, these increased quantity of assets, so the decision is straightforward, you always capitalize. For an improvement replacement, if it primarily increases life of the asset and the old carrying value is unknown, you debit accumulated depreciation. If, however, that improvement replacement primarily increases usefulness or capacity, then you capitalize it directly to the asset account. For an ordinary repair, this is always treated simply as an expense in the current period. And finally, for an extraordinary repair, if it either increases life or increases usefulness, then you capitalize it, applying the appropriate rules for improvements or replacements based on that specific impact.
That chart truly provides a clear, actionable framework for these critical accounting decisions. It simplifies what might initially feel like a very complex set of rules into clear decision pathways based purely on the expenditure's purpose and its ultimate impact. It really is all about the purpose and effect of that cash outflow. Okay, we've covered purchased assets in incredible detail, all the nuances of what gets included in cost and the capitalized versus expense decision. But what happens when a company decides to build its own assets? Like if a tech giant constructs a massive new data center entirely from scratch, or a car manufacturer designs and builds its own highly specialized machinery for a new production line. This sounds like the deepest dive yet, especially with that recurring mention of capitalizing interest, literally the cost of money itself.
You are absolutely right. This is where the intricacies really compound, and it's definitely a common area of challenge for many people trying to understand accounting. When a fixed asset is constructed by a company itself, its cost isn't merely what they paid external vendors for materials or parts. The cost capitalized to the asset must include all expenditures incurred to bring that asset to its ready-for-use condition. It's essentially creating its self-constructed historical cost.
So, beyond the obvious stuff like materials and the wages for the construction workers, what sorts of costs are we talking about here for these self-constructed assets? What gets included?
Well, beyond the clear-cut direct materials and direct labor, the raw ingredients and the wages of the workers physically building it, there are a few other key elements that must be considered. It includes repairs and maintenance expenses that add value to the fixed asset, specifically differentiating these from ordinary repairs, because these are significant efforts during the construction phase that intrinsically enhance the asset's future worth. And then there's overhead. This isn't just direct overhead related to the project. It even includes a really interesting detail: any idle plant capacity expense.
Idle plant capacity, that's quite interesting. So if part of their existing factory, say a whole production line, is sitting empty and not producing anything because all the workers and resources are tied up constructing this new asset, the cost associated with that unused space or machinery can actually be capitalized as part of the new asset's cost.
Yes, that's correct, under specific circumstances. The rationale is that if that idle capacity is a direct result of and necessary for the self-construction project, then those costs, which would otherwise simply be expensed as period costs with no offsetting revenue, can be considered part of the overall economic sacrifice required to bring the new asset into existence. It's about reflecting the full opportunity cost involved. And then, as you alluded to, there's the big one, construction period interest, which is truly the most complex and nuanced component of self-constructed asset costs, and it absolutely warrants its own dedicated exploration.
Let's do it then. Capitalization of interest costs. This sounds like an area ripe for misunderstanding if you don't grasp the underlying rules, but absolutely crucial for big, long-term projects.
It really is. The core idea behind it is that under specific, quite stringent conditions, interest incurred during the construction period of a qualifying asset is added to the asset's cost. It's capitalized, rather than being expensed immediately on the income statement. The fundamental rationale is that this interest is considered a necessary cost of getting the asset ready for its intended use, just like the cost of the steel beams or the wages of the construction workers. It's viewed as part of the all-in cost of creating that asset.
Okay, so it's about reflecting the true comprehensive cost of building something, even including the cost of borrowing the money needed to fund its creation over time. What types of assets are actually eligible for this special interest capitalization treatment? It's not everything, right?
No, not everything. Generally, buildings, machinery, or land improvements, constructed or produced for others or to be used internally, qualify. Also, fixed assets intended for sale or lease, and constructed as discrete projects, such as real estate projects. Think a large residential condo development or a commercial office park built for sale or lease. And as we discussed earlier, land improvements are also eligible. It's very important to note for land improvements, though, that if a structure is placed on the land, charge the interest cost to the structure, not the land. This means the capitalized interest cost is typically associated with the depreciable asset, the building or the improvement, rather than the non-depreciable land itself.
Right. So if a company is building a new factory, the interest on the loan they took out specifically to build it can become part of the factory's capitalized cost. But if they're just buying a piece of raw land to hold on to for speculative investment purposes, hoping the value goes up, that interest is simply an ordinary expense.
Precisely. It must be a qualifying asset that is undergoing a period of active construction or significant development to be eligible for interest capitalization. Holding raw land for future general use or pure speculation does not qualify under these rules.
Okay, now for the big one, computing capitalized cost. How do accountants actually figure out precisely how much interest to capitalize for a given period? This sounds like it involves some potentially complex calculations.
It does, and it really revolves around a core concept called the weighted average amount of accumulated expenditures, which is often referred to as calculating avoidable interest. The amount of interest that can potentially be capitalized for a period is determined by applying an appropriate interest rate to the average amount of expenditures that have accumulated specifically for the qualifying asset during that construction period. The underlying idea here is that this represents the amount of interest expense that could have been avoided if the company hadn't undertaken that specific construction project in the first place.
Okay, so it's not based on the total loan amount they might have borrowed up front, but rather on the average amount of money they actually spent and had tied up in the project over that specific period. That's the base for the calculation.
Exactly. It's about the funds actually deployed in the project during that time. And then, regarding the interest rate on borrowings to apply to those expenditures, if there's a specific new borrowing, a loan taken out directly and clearly tied to the asset's construction, then the allocated interest cost is equal to the amount of interest incurred on that new borrowing. You basically use that specific loan's interest rate for the portion of the average expenditures it covers.
Okay, so if I took out a specific 10% loan just for building this new research facility, I'd apply that 10% rate to the average expenditures funded by that specific loan. Makes sense. But what if my average accumulated expenditures during the period exceed the amount of that specific new borrowing? What interest rate do I use for that excess amount?
That's where the interest rate on excess expenditures rule comes into play. If the average accumulated expenditures outstanding exceed the amount of the related specific new borrowing, then interest costs should be computed on the excess using the weighted average interest rate for other borrowings of the company. Essentially, for the part of the project not directly covered by a specific construction loan, you're effectively tapping into the company's general pool of debt, so you use the average cost of that general borrowing. It becomes a blended rate calculation if funds are coming from multiple sources.
Right, so it really tries to reflect the true cost of all the money that was effectively tied up in getting that specific project built during that period. And is there a cap? Is there a limit on how much interest can actually be capitalized regardless of these calculations?
Absolutely, and this is a critical limitation, a firm ceiling that you cannot breach. Total capitalized interest costs for any particular period may not exceed the total interest costs actually incurred by an entity during that period. End quote. In simple terms, you can never capitalize more interest onto an asset than the company actually paid out or incurred in interest expense across all of its borrowings in that same period. This acts as a reality check, preventing companies from artificially inflating asset values with theoretical interest calculations that exceed their real-world interest burden. And for consolidated financial statements, this limit applies on a consolidated basis across the entire group of related companies.
That makes perfect sense. You can't just invent interest to capitalize. It has to be real interest the company actually incurred and paid. Is there anything else that doesn't reduce the capitalizable interest that might seem intuitive but isn't allowed by the rules?
Yes, there is one common trap. People sometimes think that if a company earns interest income on any unexpended portion of the construction loan, for example, if they borrow a large sum for a project, but only spend it gradually and temporarily invest the unused funds in short-term securities earning interest. They think that interest income should reduce the amount of interest capitalized onto the asset. But the rule is very clear. Do not reduce capitalizable interest by income received on the unexpended portion of the loan. End quote. That interest income earned is treated separately, usually as investment revenue or other income, not as a direct offset to the construction interest costs being capitalized.
That's another vital detail that could easily trip people up if they're not careful. The CPA exam pass key rules mentioned in the source seem to condense all this complexity really well, don't they? They offer a great, concise summary.
They absolutely do. They distill these often complex rules into two truly essential actionable points. Rule 1. Only capitalize interest on money actually spent, not on the total amount borrowed. This powerfully reiterates that weighted average expenditures concept we discussed is all about the funds actually deployed in the construction during the period. And Rule 2. The amount of capitalized interest is the lower of actual interest costs incurred, or computed capitalized interest, avoidable interest. This is the ultimate determinant, the final check. You calculate the theoretical avoidable interest based on your average expenditures and the appropriate interest rates. You compare that number to the actual total interest paid by the company across all its debt in that period, and then you capitalize the smaller of those two figures.
That's incredibly clear and a fantastic way to simplify the core decision process. So let's make this concrete now with example 1, Convisor Soup Kitchen Inc. Can you walk us through how these rules apply in a practical scenario? This is really where it all comes together, I think.
This example is perfect for illustrating exactly how these rules interact in practice. Okay, the facts are these. On January 1, Year 1, Convisor Soup Kitchen Inc. signed a fixed-price contract to have a new kitchen built for a total cost of $1 million. On the very same day, they specifically borrowed $500,000 just for this construction project, and that loan carried an 11% interest rate. Any remaining construction costs beyond that $500K would be financed by the company's existing general debt, which had a weighted average interest rate of 9%. Now, throughout Year 1, Convisor had average accumulated expenditures on the kitchen construction totaling $600,000. And crucially, they also incurred actual total interest costs on all their borrowings, the specific loan plus all other debt, during Year 1 amounting to $150,000. Our task is to calculate Convisor's capitalized interest costs for Year 1 based on these facts.
Okay, let me recap. $600,000 in average expenditures for the year, a specific construction loan covering $500,000 of that at 11%,
What?
other general debt carrying a 9% weighted average rate, and the company's total actual interest incurred for the whole year was $150,000. How do we start breaking this down to find the capitalized amount?
Right. We begin by applying the specific loan rate to the portion of the average accumulated expenditures that it covers. The specific loan covers the first $500,000 of the average expenditures. So we take $500,000 and multiply it by that loan's specific 11% interest rate. $500,000 times 11% gives us $55,000. This is the interest directly attributable to the specific construction loan financing that portion of the project.
Got it. So that $55,000 covers the interest cost related to the first $500,000 of the $600,000 in average expenditures. What about the excess expenditures beyond that specific loan, the remaining amount?
Exactly. The excess expenditures are calculated by taking the total average accumulated expenditures of $600,000 and subtracting the $500,000 covered by the specific loan. That leaves us with $100,000 in excess average expenditures. $600K, $500K wheels $100. For this $100,000 excess, we must use the weighted average interest rate for the company's other general borrowings, which The problem states is 9%. So we take that $100,000 excess and multiply it by 9%, which gives us $9,000.
Okay, so the total computed capitalizable interest, which is also called the avoidable interest, is simply the sum of those two calculated amounts, right?
Exactly. We add the $55,000 calculated using the specific loan rate to the $9,000 calculated using the weighted average rate for the excess. $55,000 plus $9,000 totals $64,000. This $64,000 represents the theoretical amount of interest that Conviser could have avoided incurring during year one if they hadn't undertaken this specific kitchen construction project based on their average spending on it.
And then we apply Rule 2, that final crucial check. The lower of actual interest cost incurred or computed capitalized interest. That's the last step.
That's the absolutely essential last step. We compare our computed capitalizable interest of $64,000 with the actual total interest incurred by Conviser from all their borrowings during year one, which the problem told us was $150,000. Since $64,000, the computed amount, is lower than $150,000, the actual total interest incurred. The full $64,000 is the amount that gets capitalized as part of the new kitchen's cost basis on the balance sheet. The remaining $86,000, $150,000 in actual total interest minus the $64,000 that was capitalized is treated as regular interest expense on the income statement in year one.
That example perfectly illustrates how all those rules we discussed come together using the specific rates first, then the weighted average rates for the excess, and finally that critical lower of check against the actual total interest the company incurred. It truly makes the concept of avoidable interest concrete and clearly shows the real-world impact on a company's balance sheet versus its income statement. So we now know how to calculate capitalized interest, but for how long does a company actually keep capitalizing it? What precisely defines the capitalization period? It's not just from the moment they take out the loan or buy the land, right? There are specific start and stop points.
That's a critical point, yes. The capitalization period doesn't simply start when a loan is secured or when land is purchased. According to the rules, it begins when three conditions are present simultaneously. All three must be met concurrently for capitalization to officially start. First, expenditures for the asset have been made. This means you've actually started spending money on the physical construction or development of the project itself. Cash is flowing out for the asset. Second, activities that are necessary to get the asset ready for its intended use are in progress. This means active construction, planning, design, permitting, or other essential development work is actually underway. You're actively working on it. And third, interest cost is being incurred. You actually have outstanding debt related to the project or just general debt that is generating interest expense during this period. Only when all three of these conditions, spending money, working on it, and incurring interest are met at the same time, does the capitalization period begin.
Okay, so you need to be actively spending, actively working on the project, and actively paying or accruing interest on some debt for capitalization to kick in. And presumably, it continues as long as those three conditions remain present.
That's generally right. It's an ongoing assessment throughout the project's life. However, there's a very important distinction to make when it comes to project delays, which often happen. Capitalization stops during intentional delays in construction. For example, if a company deliberately decides to halt construction for several months because of, say, a sudden downturn in the economy, maybe a glut in the market for the condos they're building, or just a strategic reassessment of the project, that's considered an intentional delay driven by management decisions, and interest capitalization must pause during that period.
But the rules also say it continues during ordinary construction delays, so a major difference there based on the nature or cause of the delay.
Absolutely critical distinction, yes. Ordinary construction delays are generally unforeseen and considered sort of a normal part of the rough and tumble of large construction projects. Think of things like delays caused by unusually adverse weather conditions, like a hurricane stopping work, minor temporary material shortages, unexpected soil conditions found during excavation, or standard routine permitting delays from government agencies. Interest capitalization continues during these ordinary delay periods because they are seen as unavoidable parts of the process of getting the asset ready for its intended use. It's not a deliberate strategic decision by the company to stop work.
That's a great practical nuance that really reflects real-world project management challenges. When does the capitalization period finally end? When do you stop adding interest to the asset's cost?
The capitalization period officially ends when the asset is, or independent parts of the asset are, substantially complete and ready for the intended use, regardless of whether it is actually used. The key phrase there is ready for intended use. It doesn't actually matter if the company hasn't physically started using the asset yet. If it's functionally complete and capable of performing its intended purpose, interest capitalization stops for that asset or part. Furthermore, if a large project like a multi-story office building or condo complex has independently usable sections, for example, lower floors that can be leased out or sold even while the upper floors are still under active construction, capitalization can cease for those completed independently usable sections even if the rest of the project is still ongoing.
That makes perfect sense. Once a part is ready to potentially start generating revenue or be used, the cost of getting it ready, including financing costs related to that part, should be finalized. And companies have to disclose all this interest information in their financial statements, don't they? For transparency.
Yes, absolutely. For full transparency and to provide a complete picture to financial statement users like investors and analysts, companies are required to disclose two key pieces of information regarding interest. First, the total interest cost incurred during the period across all borrowings, and second, the capitalized interest cost for the period, if any. This allows anyone reading the statements to understand the full scope of the company's interest expense and, crucially, how much of it was capitalized as part of an asset's cost versus how much flowed through the income statement as an expense for that period.
This all sounds very logical, but also quite detailed. The source provides another fantastic example, too, a timeline illustration that really puts all of these capitalization period rules into action across a series of events for a project. This will really help us tie everything together. Let's walk through that step by step, applying the rules as we go.
Agreed. This timeline is an excellent way to solidify all the concepts we've just discussed regarding the capitalization period, when it starts, when it stops, when it pauses. Let's trace the events for this company planning a condo project.
Okay, starting right at the beginning, on Jan 2, year 1, the company purchased a $1 million parcel of land for speculation, paid $600,000 down, borrowed $400,000 at 12% per year. Then, a couple of months later, on March 1, they paid interest cost of $8,000, which covers 2 months. How is that initial $8,000 of interest treated? Capitalized or expensed?
In this initial phase, that first $8,000 in interest is expensed. And the reason's critical. The land was purchased explicitly for speculation. At this point, back in January and February, there were no activities necessary to get an asset ready for its intended use as part of a specific construction project underway. The land was just being held. Therefore, the three conditions for capitalization, spending, activity, interest were not simultaneously met. It was simply an investment holding. And the interest cost on the debt used to finance that holding is treated as a regular, immediate expense.
Okay, so the purpose of the land's acquisition at that specific time dictates the initial treatment. Got it. Then, the very next day, on March 2, year 1, the company makes a decision to build condo project on the land, and attorneys apply for zoning permits. Does capitalization begin right here, even though they haven't broken ground?
Yes. According to the rules, this is the precise moment the construction period begins for interest capitalization purposes. Even though no physical construction, like digging, has started yet, activities that are necessary to get the asset ready for its intended use, specifically applying for crucial zoning permits, are now officially in progress. Expenditures have definitely been made for the land and its financing, and interest is clearly being incurred on that $400,000 loan. So as of March 2nd, all three conditions are now met simultaneously. Capitalization starts now.
Okay, interesting. So the start isn't tied to physical construction, but necessary activities. Then on May 1, year 1, they paid interest cost of $8,000 covering the next 2 months. What happens to this $8,000 of interest?
This interest payment, covering the period from March 2nd onward, when capitalization began, is now charged to the building, meaning it is capitalized as part of the condo project's overall cost basis. From March 2nd onward, the intent and the activities directly align with active construction development, so the related interest gets added to the asset.
Makes sense. Moving on to Step 1, Year 1, they begin grading and developing land and foundation, paid 4 months interest. That would be another $16,000, $400K, 12%, 412, capitalized too.
Yes, that $16,000 covering those 4 months is also capitalized to the building. Physical construction activities like grading and foundation work are clearly underway now, further solidifying the ongoing capitalization period.
And finally, for year 1, on Decode 31 year 1, the company reports incurred expenses to date for attorney, architect, and land development, all paid with additional borrowed money. And they also paid 4 months interest. How do we calculate the capitalized interest for this final period of the year?
Okay, at this point, the total accumulated expenditures that are subject to interest capitalization have grown. They include the initial $400,000 loan for the land, plus the additional $300,000 borrowed and spent on the development costs incurred from September through December. So the base for capitalization is now $700,000. 400K plus 300K. Since the interest rate on the initial loan, which we'll assume applies here for simplicity, though in reality we might need a weighted average if the new borrowing had a different rate, was 12% per year, and this covers the last 4 months of the year, Sep 1 to December 31, the capitalized interest for this period is calculated as $700,000 multiplied by 12% multiplied by 412 for 4 months, which equals $28,000. This $28,000 is also capitalized to the building's cost.
Okay, so summarizing all of year one then, what would be the required disclosure of interest on the company's financial statements for that year?
Right, based on our calculations, the company would need to disclose 2 key numbers. First, total interest costs incurred during the year equals $60,000. This total includes the initial $8,000 that was expensed during the speculation phase, Jan-Feb, plus the $8,000 MAREP, $16,000, and $28,000 Ariciptec incurred during the capitalization period, 8K plus 16K plus 28K equals 60K. And second, they would disclose interest cost capitalized equals $52,000. This $52,000 is the sum of only those amounts incurred after capitalization began on March 2nd. The $8,000 plus $16,000 plus $28,000. The difference, $60,000 total incurred minus $52,000 capitalized equals $8,000, represents the interest correctly expensed during the initial speculative period.
That's the perfect illustration of how the expensed and capitalized portions are carefully tracked, derived, and then presented clearly for transparency. Excellent. Now, year two brings some interesting developments in the timeline, specifically regarding those delays we talked about. What happens if there's a wildcat strike starting on Jan 2, year 2? Does capitalization stop?
No, it doesn't stop. A wildcat strike, which is typically an unauthorized work stoppage, is generally considered an unintentional delay from the company's perspective. These are often unforeseen circumstances and are considered part of the ordinary course, the risks of large, complex construction projects. Therefore, according to the rules, during this period of the strike, interest capitalization continues. The project isn't being deliberately paused by management decision, so the cost of financing associated with the ongoing, though delayed, project continues to be capitalized.
Okay, so an unforeseen strike doesn't stop the capitalization clock, but then on April 1, year 2, the timeline notes. Glut on condo market, construction delayed intentionally. This sounds fundamentally different based on our earlier discussion.
It is, absolutely. This is clearly labeled as an intentional delay. It's directly driven by management's strategic decision, likely based on unfavorable market conditions or perhaps internal resource allocation choices. Because the delay is intentional and not part of the ordinary, unavoidable construction process, interest capitalization stops during this period of intentional delay. It will only resume when active construction activities recommence.
That's a really clear distinction based purely on the intent behind the delay. Very important. And then the timeline shows that on Aug 1, year 2, construction continued. So capitalization starts again.
Exactly. At this point, capitalization resumes because the activities necessary to get the asset ready for its intended use are once again actively in progress, and presumably expenditures are being made and interest continues to be incurred on the project's financing.
And finally, there's a nuanced point on October 1, year 2. Floors 1 to 3 of the 10-story condo building are completed and ready for sale, except for light fixtures and wall coverings. How does this affect capitalization?
This perfectly illustrates the rule about independent parts of the asset being substantially complete. For those specific floors 1 and 3 that are now structurally complete and functionally ready for their intended use, ready for sale in this case, even if they're awaiting minor cosmetic finishes like light fixtures, interest capitalization ends for those specific independent parts. The logic is, those units are now substantially complete and could theoretically generate revenue or be used. Construction interest capitalization would only continue for the remaining floors 4 through 10, which are still under active development and not yet ready.
And then finally, on to Decode 15, year 2, the timeline simply states building and project completed.
At this point, the entire asset, the whole condo building, is substantially complete and ready for its intended use, sale or occupancy, regardless of whether all units are immediately sold or occupied. Therefore, as of December 15th, interest capitalization ends for the entire project. The costs of getting it ready, including all capitalized interest accumulated to date, are now finalized and integrated into the asset's final cost basis.
Wow, that timeline example truly brings all this complex start, stop, pause, and continue rules for interest capitalization to life in a very practical way. You can really see how critical it is for accountants to track not just the spending, but the purpose of the spending, the intention behind delays, and the specific physical progress of the project itself. It's a real testament to the level of detail required in proper accounting. Well, We have truly covered an incredible amount of ground in this deep dive today. From the foundational definition of property, plant, and equipment, we've systematically unraveled the detailed, often surprising costs that go into establishing the correct cost basis for land, for buildings, and for equipment. We've explored some really intriguing nuances, like how tearing down an old building can actually be a land cost, or how a seemingly simple donated asset actually creates a reportable gain on the income statement.
And we meticulously broke down that crucial accounting decision of whether to capitalize an expenditure or expense it immediately. We carefully distinguished between additions, improvements, or betterments, replacement with their tricky rules depending on known or unknown carrying values, and the different types of repairs, ordinary versus extraordinary. Getting that distinction right is so fundamental because it directly impacts how a company's reported financial performance and its asset values are perceived and understood period over period.
Absolutely. And then we took that deepest dive into arguably the most complex part, the capitalization of construction period interest. We learned how to compute it based on those weighted average expenditures and the appropriate interest rates, the vital lower of rule comparing computed interest to actual interest incurred, and the precise conditions for when that capitalization period begins, continues, pauses during intentional delays, and definitively ends when the asset is ready. It's really a masterclass in nuanced financial reporting.
And knowing these details, understanding this intricate process, fundamentally changes how you, the listener, can perceive and interpret a company's financial statements. You now understand that a single line item like buildings or equipment on a balance sheet represents this complex web of precise calculations and intentional accounting decisions. It reflects not just the initial purchase prices, but also all those necessary preparation costs, required enhancements, and even, significantly, the financing costs incurred during the construction process itself. This layered understanding really empowers you to look beyond just the surface numbers and truly appreciate the intricate accounting decisions that underpin a company's reported asset values and, ultimately, its long-term profitability.
It really is powerful stuff. So the next time you see a headline about a major company breaking ground on a new multi-billion-dollar data center, or opening a huge new factory overseas, or acquiring a massive piece of property, you'll know there's a whole world of detailed, precise accounting rules and calculations underpinning that single reported asset value you see in their reports. Which makes you wonder, what other seemingly simple numbers presented in financial reports might hide similar layers of fascinating complexity just waiting to be uncovered if you ask the right questions?
Keep asking, how do they get that number? Keep digging deeper and continue to explore these financial mysteries, now armed with this powerful knowledge about asset valuation.
Join us next time for another deep dive.